It's time for Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of A Bank Information. Take charge of your financial future with your personal bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show, and today I want to do something a little special. Every once in a while, it's good to go back to the basics, and I've been getting a lot of folks a lot of listeners and such who have been reaching out to me and saying, asking me the questions, how does this Your Personal Bank idea really work? So I'm going to go back to the basics and share those very things, how it works and how it can enhance your financial situation. So if you have somebody that's interested in looking at this concept, looking at this idea, I'm going to tell you this is going to be a great show for them to check it out. So go to yourpersonalbank.com, of course, or listening on the air, of course. Either way, you can pass it on to them, and they'll have a better understanding, again, of how this works and how it can enhance their financial future. So here goes. Bottom line is, what is your personal bank? Well, really, it's a financial concept where we strategically integrate financial tools from both the banking and the insurance industries to continue growth on funds even after we access them, spend them, use them elsewhere for other purposes. In other words, we want our money to continue to work for us. We want to continue to earn interest on money even after we spend it on other things. Now, I get a lot of people say, that's very interesting. How do you accomplish that? Well, how we accomplish it is really quite straightforward. It's not that complicated. In fact, if you've been introduced to the idea of the insurance banking concept, or it's known by a number of different names, it really is a very simple process. What we do, though, is we add a second step to it that turbocharges everything. And you're going to see what I mean just here in a minute. So what we do is we set up a high cash value policy. And this is a policy that's designed to maximize tax-favored cash growth. We want to grow our money. It's that simple. It's the opposite of how most people view and use life insurance. And I'm going to share just in a minute what I mean by that. The second step, of course, is we set up a bank line of credit where the cash in the policy is the collateral for the loan. Now, you're going to see what I'm talking about, how this really enhances or turbocharges this whole idea to allow you to get positive arbitrage. And if you don't know what that means, that's okay. I'm going to explain it here in a few minutes so you will understand what it means. It's getting your money to work for you twice, okay, just so you know. But anyway, first things first, the policy. When we set this up, again, we're designing it to maximize cash growth and liquidity while minimizing the death benefit. Again, this is the opposite of how most people view and use life insurance. Most people look at life insurance as a death benefit protection tool. And when I say most people, I mean most, individuals, advisors, tax people, CPAs, you name it. There's an overwhelming majority of folks who really look at this as strictly a death benefit protection tool. And they really don't realize all the uses and the things that can be done, what life insurance can actually do. See, this is the type of policy, again, it's called a high cash value policy, and this is the type that wealthy families, corporations, banks often use and been using for decades and decades to build wealth, okay? So again, if I have one challenge, I'm going to tell you what it is right now. And that challenge is, again, it's the view people have of life insurance. If I tell them, look, this is the tool we're going to use to fund this personal bank concept, to grow money, have more access, reduce taxes, create positive arbitrage. When I say insurance is the tool we're going to use to fund, a lot of people miss the point. They think of insurance, again, as a death benefit protection tool only, or they view it as, the car or auto or whatever, and they're like, I don't want another bill, stop listening, and miss the whole point. That is not what I'm talking about today. What I'm talking about is policies that pay dividends, okay? We have companies, by the way, folks, who have been paying 5.75 to 6% dividends every single year for over 25 years plus, and have never missed the dividend since literally before the Civil War. Now, when I state that, it's amazing how many people are surprised by that very fact. They're like, I had no idea that there were companies out there that had been paying dividends like that for so long. And again, if you structure it correctly, we're talking about dividends that have guarantees. You can grow the money tax-free. Technically, it's tax deferred, okay? You can access it tax-free, and you can pass it on to your heirs income tax-free. Now, again, it has to be structured correctly to do all that. But of course, we teach people how to do that. But what I want to do is go back a second. Again, we have companies. I'll show you the charts. If you want to contact me at yourpersonalbank.com, or if you're looking at watching this online, click on the link below to schedule a free consultation with me. I'll share with you the chart. I'll show you the chart of all what's considered the top dividend-paying companies for the last 25 plus years. I'll show you which they actually paid, and I'll show you companies, again, that have never paid less than 5.75 or 6% dividends, even today, and have never paid less than that for the last 25 plus years, and again, have never missed a dividend since literally before the Civil War. Folks, that's powerful, okay? That's, they paid it through the Great Depression, for example. And a lot of people have concerns, by the way, even going forward about inflation and the economy and the various things like that going forward. These are companies that are well positioned with tons of cash reserves, A+ rated. These are many of you would recognize many of the names. They're well positioned to continue to pay dividends for the foreseeable future, okay? So that's the first step. Again, setting up the policy to grow dividends. Now, before I go further a second, we do have another option where we can do an index option where you can actually, the credit based on the S&P 500, you can make double-digit returns on good market years and not lose on the bad years. And we have products that actually have averaged over 8.5% returns over the last 25 years. Now, if you consider that, where you consider the money is growth, you have no downside market risk. You can, again, grow it, access it, and pass it on tax-free. I don't know about you, but 8.5% average rate of return is not bad. I think most people would agree with that. So we can go either option with the consistent steady Eddie dividends or the index option. It just depends on the situation and what you're looking for and what's more important to you. Again, I'd recommend, if you have more questions, contact us at yourpersonalbank.com or click on the link to get more information. Now, that's the first step, the policy where we're growing the money. The second step is we set up a bank line of credit, and the cash in the policy is the collateral for the loan. This works much on the same principle of a mortgage or a cash-out refi or a HELOC. And the principle is the same in terms of as far as the loan is concerned for the bank. Again, the asset that the bank is loaning against is the cash in the policy. Much like if you had a mortgage or a refi or HELOC, the asset is the equity in the property, right? Now, here's the key. Here's the key of why this is so powerful and why it works so well. The dividends that you're earning or the index credits that you're earning are traditionally much higher, oftentimes much higher, than the interest that the banks are charging. Now, to give you an idea, the steady Eddie consistent dividend payers, as I stated earlier, 5.75 and higher for the last 25 plus years, never missed paying dividends before the Civil War. That we have banks that are charging them between 3 and 3.95% interest, depending on the size of the account and such, and how we structure it. So I always ask folks a really, really simple question. Look, if your money's earning, let's say we pick the dividend side, and you're earning 5.75, 6% dividends, and then you access the money and they're charging you somewhere in the 3s. By the way, most folks are getting 3.25 or less, by the way, today. What's your money doing? Remember, you're getting dividends of 5.75, 6% range. Historically, 6 to 8% is the historical average, just so you know. We'll talk about that further. But again, you're getting dividends 5.75, 6% range, earning. Then you access it through the bank line. You're getting charged in the 3s, most of the time around 3.25. What's your money doing? The answer is quite simple. Your money's still growing. You're keeping the difference. Most of our clients are earning somewhere around 2.5% positive arbitrage. And that's what positive arbitrage is. If you didn't know already, it's you're earning more in your money than you're getting charged. You're keeping the difference. The difference is the positive arbitrage. Now, why is this so powerful? Why is this so different? Well, it's really quite simple. And here's the one takeaway. I shared with you a couple of keys, but I'm going to tell you right now, if there's one thing I want you to remember from everything I'm sharing with you here today, the one takeaway is this. It's really quite simple. The takeaway is the positive arbitrage, the difference that you're keeping from what you're getting credited and what you're getting charged, the difference is on money that you spent. I'm going to say that again. Folks, that's on money you spent, money you allocated elsewhere, you used elsewhere. Why is that so powerful? Why is that so important? It's really quite simple. Show me, I've shared this idea for years and years, close to a decade now. Conferences, the radio shows, individuals, you name it. And I said, I've made this statement to people over and over again. Show me a way where you can earn interest on money you spent. And, they just can't come up with any other way. That's what I run into constantly. Think about that a minute. If you're earning interest on money you spent, you're keeping the difference. Say it's the 2.5% or so. Won't you have more money? Won't you have more money to spend, to live on, to supplement retirement, or do anything else you want to do with it? And the answer is, of course. So it's not about here's a mistake I see a lot of people make. It's not about comparing this investment versus another in terms of which is giving me the greater rate of return. Let me throw a thought out at you here. What if, instead of investing in an asset, hoping to get a return on that asset, what if you put it into the personal bank policy, access it from your bank line of credit, and then invest it in that asset? Would you increase your rate of return? And the answer is yes, because you're going to get your investment rate of return, whatever that is, right? Plus the positive arbitrage. So if somebody says to me, I get a 10% average rate of return, I say to them, how would you like to average 12.5, for example? If you're using this to pay bills or purchase things, you can do the same thing. You can reduce the cost of borrowing by the positive arbitrage amount. I've had many, many people that have reduced the cost of borrowing on debt or purchasing items and things like that, and they've lowered their cost of borrowing by 2.5%. This concept, the Your Personal Bank concept, is super powerful. And again, remember, when you access funds from it, if you leave it there, I get this asked all the time. Hey, if I leave the money there, will it just grow? Well, yes, of course. You're going to get the dividends, whatever they are. By the way, 5.75 to 6% currently. Historical averages 6 to 8%, just so you know, based on current interest rate environments. The loans, the bank loans are variable also, but again, they're based on prime minus 0.5% or 1%. And currently and historically, there's a difference, a positive arbitrage. It's all relative. So my point is quite simple. If you want to learn how to earn interest on money you spent, or on debt, reduce the cost of debt, or you want to increase your rate of return on other investments, I strongly encourage you to contact me at yourpersonalbank.com or click on the link below and you can schedule a free, no obligation consultation to learn more on how this can work for you. And as always, stay tuned to the Your Personal Bank Show.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. We've been really talking about what is your personal bank and how it works. If you missed the first segment, I'm just going to tell you, go to yourpersonalbank.com for more information. You can learn more about it or schedule a free consultation. Be happy to discuss it with you further. But real quick, again, we're creating positive arbitrage. And if you don't know what that means, it means you're earning more on your money than you're getting charged when you access it, so you're keeping the difference. We set up a high cash value policy designed to maximize cash growth, and then we set up a bank line of credit. The dividend rates are 5.75 to 6% currently, historically between 6 and 8% over the last 25 plus years, and have never missed a dividend since literally before the Civil War. And then the bank lines are charging in the threes, between 3 and 3.95%, depending on the size of the account, that kind of thing. So again, the simple question is always, if you're getting paid or you're earning 5.75 to 6% dividends on your money, and then you access it and you get charged in the threes, what's your money doing for you? Well, you're still earning. You're keeping the difference, aren't you? And the typical average right now is about 2.5%. We have multiple companies that we work with to fund these policies with, and we have multiple banks we work with different rates and situations depending on the client's needs and your situation. Now, the next thing I really want to talk about is, what are the uses for your personal bank? Because I get a lot of people that'll say, hey, this is very interesting. I like the idea about use my money, access my money, and that type of thing. What are some common uses? Well, the banks actually are the ones that have told me what, and client experience I've shared a number of uses that this is used for, but the banks tell me the number one use is real estate investors. See, real estate investors understand positive arbitrage. They're used to leveraging their money with using collateralized assets or collateralized loans. And let me explain further if you're not familiar with that. If you take, for example, a simple example of if somebody purchases a rental property and they get a mortgage on that property, and their mortgage payment, whatever their mortgage payment is, then they fix it up or do whatever, and they rent the property out, right? And typically what they're looking for as an investor, that the rental property, the rents they receive is more than the mortgage that they're getting charged, right? Minus other expenses and fees or maintenance costs, right? So they're looking for a difference or want to earn more than they're getting charged, right? They want to make more in rents than they're getting charged on their mortgage and expenses. The difference is profit or positive arbitrage. Now, this is an example many people are familiar with. The other thing is they're able to leverage their money by oftentimes putting down 20% or whatever and borrowing the rest. That's the mortgage part, right? Well, when I share this idea, your personal bank concept, with real estate investors in particular, they're often quickly, many times immediately grasp and understand, hey, if I can pick up 2 to 3% positive arbitrage on my money, I can further enhance my rate of return on my real estate investment. And they're correct. So often, and the other thing is liquidity needs. Real estate investors often need significant sums of money to purchase properties, for example, to then rent them out. The beauty of the personal bank concept is its liquidity. See, a lot of financial tools out there, we know, they may have safety or whatever, but they really are limited on their liquidity. Things like annuities and CDs and such. You have safety and guarantees, all that's nice, but you don't have much in the way of liquidity. Well, here's the beauty of your personal bank. When you set this up, typically we'll have anywhere from 50 to 85% cash available day one. And so, depending on how it's set up, the beauty is, and you can access that through your bank lines of credit, and depending on the situation, you can have 95 to 100% of that available. So in other words, you can have a majority of your money available to you that you use to invest in the personal bank available to you day one. Now that's very important to a lot of real estate investors. And then to pick up the positive arbitrage on those dollars, again, keeping the difference of what you're earning in dividends minus what you're getting charged in interest from the bank line, is a powerful incentive. Other uses, a lot of folks use this for home improvements. I've seen it used for debt consolidation. That's often a common way of doing it. I have fun with a lot of people where they'll have higher interest rate debt, things like credit cards and various things, car loans or various things like that, and we're able to reduce or wipe out their debt sometimes in a matter of months, if not less, or right away if we have the funds to work with. Again, if you stop paying interest on a debt, that's money in your pocket, isn't it? And then on top of that, if you can pick up the positive arbitrage, again, that 2 to 3% positive arbitrage, you're now even ahead of the ball game even further. Analogy I use all the time is to think about this a minute. If you had a debt that was charging you 5% interest, okay, and you use this tool, you could take and then money to pay it off. You could stop paying the 5% interest. That's good, and the debt is gone. Or you can use the personal bank concept where you put in the policy, access it through the bank line, pay off the debt, and pick up 2.5% positive arbitrage, let's say. Well, if you stop paying 5% and you're earning 2.5%, isn't that 7.5% gain in your favor? Apply that to credit card debts as often double digit, right? Think about the difference that it makes in the bottom line, in the cash flow for folks. It's very significant oftentimes. So that's exciting. Gosh, I have people who use this to pay their taxes. And another one that's very common is tuition, college tuition. This is one of the most common tools used to fund colleges. Most people are familiar with 529 plans, but are less familiar with personal banks. Well, here's why a personal bank, I think, in many ways can be far superior to a 529 plan. One, There's no downside market risk, for example, with the personal bank. Whether you take the index option or the dividend option, you know that the account is going to grow. Within a 529 plan, it certainly can grow depending on the market, and it certainly could lose money depending on what the market does. But secondly, personal banks assets do not go on the FAFSA form for grants and loans. 529 funds do. What does that mean? So if the student is up for a grant or a loan, they have to do a financial form. It's called a FAFSA form. It's FAFSA, and it's a financial form, and that's where you qualify or not for these grants and loans. Again, if the funds in a 529 plan are applied to that, and it could make the difference in terms of the student receiving that grant or loan, or how much. Life insurance cash values do not go on the form, so they're not counted. And probably the third and sometimes the most important reason I feel that personal bank assets are often superior for college funding is, well, the money when you access it is tax-free for any reason. 529 plans, of course, have to be educationally focused, and if not, you can lose the tax benefits. What if the student gets a full ride scholarship, for example, or doesn't go to college at all? Those things happen. The tax-free benefits of the 529 plan go away, but you can access the funds from the personal bank using the cash value policy and accessing from the bank line and create a tax-free plan irregardless of what the funds are used for. So there are many, many myriad uses for this tool. And if you want more ideas or how it can be used, we have some fun ones to share sometimes. Contact us at yourpersonalbank.com for more information, or click on the link below if you're watching this online to get more information.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show, and today we're going back to the basics. I've been getting asked by a lot of folks, what is your personal bank? How does it work? And really in the first two segments, I've really spent a lot of time on those very issues. If you missed it, go to yourpersonalbank.com. Highly encourage you to check it out. And again, this will be a show for anybody that may have an interest in looking into this, of really kind of being introduced to the whole idea. If you're already familiar with it, that's okay, because sometimes going back to the basics is good. The next one I get a lot of the time. So we talked about how your personal bank works. What is it? How does it work? We've talked about some of the common uses for it. But the next one I probably hear a lot is, well, why haven't I heard about this? Or it's too good to be true. I hear those kinds of things, obviously. Let me tackle both of those. First of all, why I haven't heard about this? Well, there's a number of reasons behind that. Probably one of the most common, though, is really truly a lack of familiarity. In other words, most financial advisors, insurance agents, don't really deal with insurance a lot. And it sounds counterintuitive when you say insurance agents. The vast majority, I've seen statistics show that as high as 90% of licensed insurance agents, for example, never write a life insurance application in their career. In other words, they primarily focus on annuities. Now, I'm not saying annuities are bad or anything. It's just annuities are a whole different type of product, but they require an insurance license. Go figure. So my point is, they're really not an insurance agent or specialize in insurance in any way. They are really more the annuity focused. And your financial advisors, well, they deal with stock, bond, mutual funds, and all types of different things. And it's hard to be an expert on everything, especially when their focus is primarily, say, market focused. This is usually, let's just say, it's an afterthought for many advisors, and they don't want to or don't have the desire or the time to really invest to become a specialist in this. In fact, a number of my clients happen to be financial professionals because they understand I have a much greater understanding of this. This is my specialty. This is what I do. I've done for this for nearly a decade out of my 22 plus year financial career. It's all I do pretty much. And you become an expert in that, obviously. So they come to me. So again, it's just the lack of familiarity, knowledge, expertise, all those things, right? The other reason that's really I find quite common is in how these policies are structured. I share the idea of a teeter-totter all the time, okay? And if you picture in your mind a teeter-totter, well, you put the cash value on one side and the death benefit on the other. And how, again, most insurance policies are structured is most people, you know what I mean. To purchase insurance, you say, well, what's the least amount of premium for the biggest death benefit, right? That's how most people view and use life insurance, and it's a death benefit protection tool. Again, we're doing the opposite. We flip the teeter-totter on its end, completely the other way, okay? And we're maximizing cash and we're minimizing the death benefit. Well, guess where a lot of the commissions and such are built into these products? For the most part, it's based on the death benefit amount, not cash. Cash is cash. There's just not a lot of commission involved in cash, right? So if we're reducing the death benefit by 50 to 80% day one and every year, which is what we typically do, we're reducing the commissions or the fees or the what goes to the advisor or the agent by 50 to 85%. So there's a compensation issue that a lot of advisors or agents have. They don't want to see that type of reduction, if you know what I'm trying to say, in their commissions or their fees or their compensation. But here's the other thing about that that's interesting. If we're reducing, that's another question I get all the time. Well, what about the cost of insurance or my age? I'm too old for it. Folks, I want you to understand, we've successfully funded policies for folks up to age 79, and the numbers work because, again, we're not focusing on maximizing death benefit. Think of the teeter-totter. We're focusing on maximizing the cash. So we're bringing the death benefit way down. It's a lot easier to qualify for a lot less. But here's the other thing it does. If you're reducing the total amount of insurance by 50 to 85%, guess what you're doing to the cost of insurance? Also reducing it by 50 to 85%. So again, the cost of insurance and fees and such, which is sometimes a knock on insurance out there by various advisors, that goes off the table because we're dramatically reducing those costs and fees, aren't we? Now this product becomes far more competitive, and it becomes very competitively priced, if you will, in terms of a fee standpoint compared to a lot of other investment tools that are out there. So again, it turns everything on its head. Everything you knew about insurance, what I have to tell people is you just have to forget that or reverse it because it's completely the opposite. And again, that's part of how using your personal bank works, by maximizing the cash. And then by bringing in the bank line to create the positive arbitrage, that just turbocharges everything. It adds an extra oomph on it over and above what, like the insurance banking concept that many people are familiar with. So we bring it to another level. As always, contact us at Your Personal Bank for more information or click on the link below to schedule a free, no obligation consultation.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Okay, we are wrapping things up today. Welcome back. We've gone back to the basics today. And again, if you've heard this before, that's okay. Sometimes going back to the basics is a good thing. Again, if you missed it, if you missed the previous segments, I'm going to really encourage you to go to yourpersonalbank.com, check it out, pass it on to somebody. This will be a really, really good show to share with somebody who really you think might have an interest in looking at this. What is your personal bank? How does it work? What are some common uses? What are some of the common questions? Or why haven't I heard about this? Or why is it too good to be true? Those kinds of things. In fact, I didn't get to that one, so let me do that now. Too good to be true. Remember, what are we doing? We're setting up a high cash value policy. We've got companies that have been paying dividends 5.75%, 6% or greater for the last 25 plus years, never miss a dividend since before the Civil War. That often surprises people when they hear that. And they're like, how can companies pay, those type of dividends with this extraordinarily low interest rate environment we've had for the past decade or so? Well, the answer is really simple. And if you contact me at yourpersonalbank.com, I'll be happy to send you some information or click on the link below. Where I'll show you the annual reports of some of the companies. In other words, when we give money to the insurance company, what do they do with it? They invest it to make money, right? And what does a typical insurance company earn on those things? Well, the annual reports show us that they earn somewhere between 9.5 to 10% typically on a normal year. So and by the way, I'm looking at some of the companies. 2020 was a tough year financially, but most of the companies I'm looking at made over 8% return on their money. In fact, one of them, 8.3, that I work with a lot. Look, if they're making 8 to 10% returns on their money, the money we give them to invest, can they pay us 5, 7, 5, or 6 and make a profit on billions of dollars? The answer is yes, absolutely. So, folks, it's not too good to be true. In fact, these companies have been very quietly just kicking along, paying dividends every single year. And one of my frustrations is, I wish they shared that more, advertised that more. So that's maybe part of our job. And again, the second part is where we really turbocharge this idea. So again, if you have looked at or were introduced to the insurance banking concept at some point, I'm going to tell you to really encourage you to look at it again, because we've added another step to it that turbocharges everything. And that step is the bank line of credit. Look, you can set one of these up in a policy and access the funds directly from the policy, and it works, and it'll work. But if you bring in the bank line of credit, we can increase the positive arbitrage, typically 2 to 3 times more positive arbitrage. Our average client is making about 2.5% positive arbitrage today, and that is about close to the historical average, by the way. That's one of the other questions I often get. Well, okay, interest rate dividends and interest rates are low right now. That is absolutely true. What about when they go up? Well, dividends are interest rate sensitive. Historically, I'll show you the charts, late 90s, early 2000s, the average dividend was between 7 and 8%. That was the norm. So these historically pay somewhere around 6, 7, 8% dividends. That's the norm. We're on the low end of that spectrum because of the current interest rate environment. The bank lines of credit, because they're fully collateralized lines, they are at prime minus 0.5 or prime minus 1%, depending on how much money we're talking about. Now, here's the thing. What is that? Prime is considered typically the lowest rate an individual can borrow money at. Prime is one of the lowest rates, again, that you can borrow at, and currently it's, below 3%. So if you're looking at a loan where you're at below prime and the dividends historically, again, 6 to 8%, you can see where a 2 to 3% positive arbitrage is the norm, is the historical norm. In fact, I have one of the companies that have some documentation they've showed me where the dividends that they paid every single month were higher than the interest charged on the loans every single month for the past 40 years, except for 2 months where they happened to be equal, which means you didn't get hurt. The point is your positive arbitrage historically has been there consistently. And let me give you one last thought. What if it's a worst case scenario situation? What if, for example, interest rates really got out of whack and things moved quickly and maybe the bank interest rates changed quicker than the insurance company dividends? That's feasibly, that could happen, certainly. What then? Well, remember, when you access funds from these policies, here's the thing. If you leave it there, it grows, right? I think we all understand that. And I have clients that even ask me, you talk about this positive arbitrage and all. Can I just leave the money there and just let it grow? And the answer is absolutely. I mean, in a lot of them, 5, 7, 5, 6% dividends consistently every single year with guarantees, tax-free, and knowing they have access, they're like, that's good enough for me. By the way, there's also a long-term care benefit, and funds for long-term care type costs built in, no additional costs. So if you need that, it's kind of nice to know it's there. If you don't, you didn't pay extra for it, so that's nice. And there is a death benefit. Again, we're trying to minimize that and maximize the cash, but there still is one. So that can offset, particularly if you're talking about a couple or loved ones, somebody passing away prematurely, that can offset lost income, for example, things like that, protect loved ones. But my point is, I digress there for a minute. My point is, if you're consistently earning dividends or index credits, and those are higher than what you're getting charged, when you do access the money, for whatever reason, you're keeping the difference. And remember, I said this in the first segment, don't ever forget this. Remember, this is the takeaway. The difference you're keeping, the positive arbitrage, is on dollars you spent, dollars you allocated elsewhere. What did you do with those dollars? I don't know. That's entirely up to you. You could have invested in them in another asset and picked up another 2 or 3% rate of return on your investment because you're getting the positive arbitrage. That's nice. You could have paid off debt. Maybe you had some debt you wanted to get rid of, and you reduced the cost of your borrowing by 2.5%, 3%. That's a very positive thing too. Or maybe you're considering purchasing an item and maybe considering financing it, like a car or something like that. And again, you can reduce the cost of borrowing by using this tool. It's the positive arbitrage that makes the difference. Now, some people will say to me, well, 2-3%, that's nice, but that doesn't change. It's not dramatic. That doesn't change a lot. Yes, it does. Here's why. Here's what you're missing. That positive arbitrage is every single year for the rest of your life. Now, if you understand compound interest, you understand that a 2.5% positive arbitrage in 10 years is 25% more money, isn't it? That's without any compounding. You start to see now where the difference of money in your pocket that you would have available to spend, use, allocate however you want, starts to become significant, especially as time goes by. Now, again, I heard we covered, well, that sounds too good to be true, or what about the cost or the fees? They're minimal because we're maximizing cash versus death benefit. Liquidity is 50 to 85% day one, 100% liquid, typically in a few years. If you missed some of that stuff, go back to yourpersonalbank.com and listen to the previous segments where I talked about that in more depth. I also talked about why most financial advisors, CPAs, tax folks are not familiar with this or haven't brought it up. I get the thing about why I haven't heard about this, okay? That's the reason why I do this show. And so I guess some of the last thoughts I kind of want to leave folks with on is the fact that we're bringing this to people's attention because I was introduced to this myself, as I was one of the top financial people in the annuity world for years, retirement planning, IRAs, 401ks, all that type of stuff. I had no understanding of this. I had no knowledge of this either until it was introduced to me, and then I got into the banking industry. As you know, I'm on the board of a bank in the process of starting a FDIC insured bank. Banks use this quite extensively, okay, this tool. My point is this: high finance, wealthy families, corporate finance boards, banks, various things like that use this tool quite often. It's very common. It's not generally used with the general public, or it's not introduced to the general public for a number of reasons. We're doing that because I feel, hey, if you can get positive arbitrage, it doesn't really matter how much money you have, if you have a lot or a little or somewhere in between. Getting the positive arbitrage, having that extra money in your pocket, I use the example, if you get 2.5% positive arbitrage, that's 25% more money without compounding in a decade, and those are dollars you would have never seen any other way, right? Because what did you do with those dollars? You actually spent them. You used them. You allocated them elsewhere. You invested in something. You paid off a bill. You bought something, right? Because remember, the positive arbitrage comes into play when you use the dollars. There's no cost or fees for these lines of credit of any kind. They only charge you interest when you access the funds. I get another question I often hear. Let me hit that one before we run out of time. People say, well, I'm going to have to pay back the loan. When I access these funds, I got to pay back the bank line of credit. The answer is not necessarily. Now, if you have the funds to pay back the loan, by all means, I encourage you to do so. Because if we look at the dividend options, the steady Eddie dividend options, again, that are right now paying 5.75%, 6%, historically pay 6 to 8%. Look, if you don't have a loan, your money's growing faster. It's growing 6 to 8% historically, right? If you have a loan against it, the bank line, you're probably growing at 2 to 3% because you're keeping the difference. So if you pay the loan back, your money's going to grow faster. That's just obvious. But if you're unable to pay back the loan, or you're going to using this to supplement retirement, for example, and you have no intention of paying back the loan, would you have more money in the long run? And the answer is Yes. As long as you have positive arbitrage, as long as you earn more in dividends than you get charged in interest, you keep the difference, your money grows, doesn't it? And again, I shared earlier with the historical averages being around 2 to 3% annually, that means you would have 2 to 3% more money available annually every year for the rest of your life. This is how, folks, this is a great tool to enhance retirement income. And again, the other benefits of it being income tax-free and having guarantees and having lots of liquidity, those are just, icing on the cake, if you know what I'm trying to say. So again, folks use this for many, many different reasons. And if you're concerned about the debt thing where I got to pay, I don't want to have a debt, I want to pay it back, I understand where that comes from. We're taught debt is bad, right? We don't want to borrow money, right? Especially when we get into retirement and things like that. Well, generally speaking, I agree with you. Debt is something you want to get rid of. But the last key on that you want to understand before we finish up today is this. You need to understand the difference between strategic debt and consumer debt. Consumer debt is debt where you have to work to pay off the debt. If you have to work, go to work to pay the bill, whether it's your business or your company or your job or anything else, doesn't matter. If you have to physically do something to pay the bill, you want to get rid of that kind of debt as soon as possible, because that's the kind of debt that can get you in trouble. Because what if something happens to that income? What if, the job gets cut or eliminated, or the business takes a downturn, or the economy takes a downturn, or you have a health situation or a disability or any number of things that happen in life, right? Stuff happens. If something happens to your income and you have that kind of debt, you've got problems, don't you? Strategic debt is different. Strategic debt is debt that's paid by somebody else's effort. Look, if you have a dividend coming in that has underlying guarantees and that dividend's higher than the interest getting charged, whether you work or not, whether you actually do anything or not, that's strategic debt. You're fine. You're not going to get hurt by that. You're not going to go underwater that way. And the best analogy I give people on that is all the time is, if you owned a rental property and it was earning more than you're getting charged, can you build wealth that way? The answer is yes. You can do the same thing with your personal bank with additional benefits, tax-free, guarantees. And as always, contact me at Your Personal Bank for more information, or click on the link below, or stay tuned to the Your Personal Bank Show.
Listen Tuesday at noon and Thursdays at 1 for more information on Your Personal Bank. Contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.